Hey guys, it's CJ Investing here. Welcome back to my channel. And today I'm going to be doing a quick deep dive on CVS Health Corporation, a stock that I currently own in my Roth IRA. I'm trying to build it into a bigger position. As you can see, this is on Yahoo Finance. As you can see, it's at $66.61. So it's pretty close to this 52-week low. I think it's up to like 68 or 69 now. As you can see, this performance of its financials as far as its earnings and its revenue, it's been going straight up. So I think it makes more revenue than what it's worth. So the revenue is higher than its market cap. As you can see, 267.9 billion and then 290 billion. This is what you want to see in a stock. A dividend stock. It has strong earnings, strong revenue. You can see all this on Yahoo Finance app. As you can see, its financials, income statement. It doesn't have the best margins because of the sector that it's in, but I believe they're going to get better in the future. As you can see, they're growing though. They are growing. Its gross profit is growing, revenue is growing. You know, they might have a bad quarter or two, but it continues to increase. It's very important about those shares that are on the market, that they're buying them back and that they're going down. Unfortunately, they have been increasing them slightly, so that's something to keep an eye on, but it's not by a whole lot. So, you know, keep an eye on that because you don't want to be diluted as a shareholder. As you can see, their earnings it's kind of up and down. You know, companies have stronger quarters than others, but year over year they're going up. As we move on to their balance sheet, we see they have a lot of cash, 15 billion in cash. Total assets 228 billion. That's a lot of assets. So they have plenty of assets. Current debt of about 1.7 billion. So that's, and then long-term debt of 50 billion, but they don't have to worry about that. As you can tell, it's long-term. And it seems like they're paying it down as far as their debt. And they have more than enough cash to cover their current debt. So that's very important. And as they move on, free cash flow is very important. You want to make sure they have enough to pay their dividends and their share buybacks, and they continue to pay down their debt. As you can see, they can. It's increasing from what I can see. Dividends paid, pay a lot out in dividends or stock repurchases, and they're paying even more down with their debt. About 4 billion is being used to pay down debt. So they're paying more in debt than they are in dividends and share buybacks, which is what I want to see, what you want to see. They're committed to paying down their debt. As you can see, there's some news articles. You have your company profile, if you didn't already know. They're big on their pharmacy. They're branded after their pharmacy. It's a very profitable sector. They also have their retail side of business, which isn't as profitable. But they have their membership. They're big on health plans, prescription drug plans, Medicaid, managed care plans offering the public health insurance. Things like that. They're obviously in the healthcare sector. So they're mainly focused on that and making more acquisitions in terms of that. Which we'll get into later in the video. As you can see, this is their stock, how it's performed. As you can see, their financials on here. Revenue lines up 322.5 billion. That was as of 2022. As you can see, the revenue as of June 2022 was 80 billion. And it constantly goes up. If you notice, the green percentage year over year is going up. 83 billion in December 2022, and then 84 billion, 84.94 actually billion in March of 2023. And the margins are pretty thin, but they're in a great financial position. And This is on Seeking Alpha app. You can download it in your app store. As you see the dividends, 1 year growth rate 10%, 1 to 3 4%. Dividend growth rate for 3 years 4%. Dividend growth rate for 5 years 2%, almost 3%, and growth rate for 10 years is 11%. But that's kind of in the past, because the thing is they had to pause their dividend growth back in, I think, 2018. Don't quote me on this, because they were making a big acquisition at the time. I think it was Aetna Care or something like that. But it was a big acquisition, and they paused their dividend growth, but they still remain to pay dividends. So they've been paying dividends, as you can see, for 14 years, and they've only been increasing them for 1 year. But they're gonna get back to that, back to increasing. This is only the beginning. So if you hang on for the ride, I believe that it's gonna pay off in the end. You know, I'd rather them do that than completely cut the dividend. You know, I hate dividend cuts. So if they, you know, at least they continue to keep it the same. They continue to pay their shareholders. So that's a good thing. You know, you wish you could kept increasing it, but I understand what they had to do as far as their acquisition, growing that side of their business, as far as with healthcare, and they're serious about that side. And that's something that Walgreens is trying to do. They're trying to branch out to their healthcare, rebrand themselves. But CVS has already done that, and they continue to do that. As you can see, that's my Roth IRA stock portfolio with Fidelity Investments. Go check it out. It's a great brokerage. And this is CVS Health on the Fidelity app. Pretty much the same information. I'm just verifying it in different apps to let you know it stays consistent. Dividend rate 60 cents per share. Yield 3.58%. That's a nice dividend yield, 3%. As you can see, their earnings, Fidelity continues to improve their metrics to which they measure these stocks at. So that's a great thing. Earnings, you know, like we saw before, it's kind of up and down. They have stronger quarters. Like Q2 is very strong for them. I noticed that. And Q1 is pretty strong as well. So I just got to continue to study the trends, you know, seeing when they're going to do well, when they aren't. But overall, they continue to grow as a company. You know, their earnings might be, I think, hit because they recently made an acquisition, as far as with Signify Health and Oak Street Health. Those are the big acquisitions that they recently just made for, I think it was less than 10 billion. I think it's 7, 8, or 9 billion, something like that. But it wasn't for a whole lot, and I think it was a cash transaction. So they didn't have to dilute any shares to make those purchases or pause the dividend, which is a great thing. So looking at the charts, this is on macrotrends.com.net. That's something that I use to look at, you know, free cash flow, the dividends, things like that. As you can see, this is their return on investment. It's within the double digits. Right there is single digits, 6.46%. And, you know, those are some videos. That was return on investment, and that's very important. As you can see, the acquisition, this is all this year. It just acquired Signify Health and Oak Street Health. I believe Oak Street was the bigger deal, but Signify Health seems to be a little bit more profitable, but Oak Street. So go ahead and check it out. Do your research first. It's a great investment. Personally, I think it's a better investment than Walgreens, but that's just my opinion. I appreciate y'all. I love y'all, and peace.